Today, we're diving into one of the hottest and most debated topics in precious metals, silver versus gold in 2026, and most importantly, why silver is moving far more dramatically than gold this year. Whether you're a trader, investor, or just curious about metals markets, this analysis will break down the latest price action, key drivers, risks, and where both markets could head next. Let's get into it. For much of history, gold has been the standard bearer of safe haven assets, a store of value in times of crisis, uncertainty, or inflation. Silver, on the other hand, has always played a dual role. It's both a monetary metal and an industrial commodity used across electronics, solar energy, EVs, medical equipment, and more. This dual identity is one of the core reasons why silver's price swings have been so much more pronounced in 2026 compared to gold. As we speak today, both silver and gold have experienced major volatility. Precious metals ETFs, including those tracking silver and gold, rallied strongly on February 9th, 2026, after a sharp sell-off last week, with silver ETFs seeing significantly wider swings than their gold counterparts. Let's unpack the structural reasons. First, market size and liquidity. The global silver market is much smaller and less liquid than the gold market. That means a relatively modest amount of buying or selling can move silver prices much more sharply than gold. According to market analysts, when inventories are tight and net demand surges, 1,000 tons of silver demand can move prices by roughly 7%, compared to only around 2% for gold in a normal environment. Second, industrial demand is far more significant for silver than it is for gold. More than half of silver demand globally comes from industrial uses, driven by sectors like solar energy and electric vehicles. Gold, on the other hand, is predominantly a store of value, with only a small share of industrial demand. That industrial component creates cyclicality. When the global economy is expected to grow, demand for silver in manufacturing and renewable technologies goes up, pushing prices higher. But when risk sentiment shifts or markets tighten, that same dual identity can bring volatility as traders flip between seeing silver as a safe haven and an industrial commodity. In late 2025 and into early 2026, silver was one of the standout performers among commodities. It saw staggering gains, outperforming gold by a wide margin. The rally was driven by a mix of macroeconomic factors, geopolitical risk, and a surge in speculative interest. However, this strength also laid the foundation for extreme volatility. One of the most significant events was a series of margin requirement hikes by the CME group on COMEX futures. The exchange raised margins for silver contracts by large percentages to better manage risk amid the extreme price swings. These hikes forced many leveraged traders to either post more capital or close positions, leading to rapid price corrections. To put it in perspective, silver's margin requirements, the collateral traders need to maintain open futures positions, jumped significantly within a short span. That forced a wave of mechanical liquidations, where positions are closed not because of fundamental changes, but because traders couldn't afford to keep them open anymore. This contributed to some of the most dramatic drops we've seen in silver price history. At the same time, gold, though certainly volatile, didn't experience the same magnitude of forced selling. Its deeper market and larger investor base helped cushion it relative to silver. Looking at the latest markets, silver experienced a rebound after last week's sharp sell-off, with prices recovering sharply on February 9th, 2026. Silver rebounded by large amounts in local markets like the MCX in India, while gold also gained, but on a much smaller scale. Analysts have noted that silver's volatility remains elevated even as gold prices stabilize above key psychological levels. This shows that silver's price action continues to be more erratic, responding strongly to shifts in sentiment, macroeconomic news, and technical market mechanics. Before we predict what might happen next, let's look at the broader forces impacting both metals. 1. Monetary policy and interest rates. Expectations around Federal Reserve rate cuts in the United States have been one of the biggest drivers for precious metals. Lower interest rates tend to be positive for non-yielding assets like gold and silver, because they reduce the opportunity cost of holding metals versus yield-bearing assets. Silver, however, has shown greater sensitivity to these expectations, likely because of its dual industrial and monetary role. 2. U.S. dollar strength and risk sentiment. Both gold and silver are inversely related to the U.S. dollar. A stronger dollar typically suppresses metal prices, while a weakening dollar can lift them. When President Trump's Federal Reserve nomination spiked expectations of hawkish monetary policy, both metals fell hard, but silver's decline was significantly larger in percentage terms, often more than double gold's drop on the same news. 3. Industrial demand trends. One unique trend supporting silver, and not gold, is exploding industrial demand. Silver's use in solar panels, EVs, 5G infrastructure, AI hardware, and other tech applications, is growing rapidly. Analysts project that these sectors will continue to drive consumption even if prices stay volatile, because there is no substitute for silver's conductivity and versatility. 4. Physical supply constraints. A deeper narrative emerging in 2026 is structural supply shortages. Inventories at major exchanges, including COMEX and other global vaults, have been dwindling. Some market participants are even questioning whether deliverable silver inventories are adequate for open futures positions, though exchanges are unlikely to allow defaults. Regardless, tight physical supply on top of strong demand can amplify price moves. So how does this stack up against gold in 2026? Gold remains the dominant safe haven. Central banks continue to buy gold aggressively, and forecasts from major financial institutions, including projections of gold reaching new highs later in 2026, reflect enduring confidence in gold's role as a reserve asset. Silver, conversely, is still heavily influenced by short-term flows and speculative positioning. That's why you'll see larger price spikes and deeper drawdowns in silver compared to the relatively steadier course of gold. And yet, this volatility is not inherently bad. Instead, it reflects the complex interplay of industrial demand, investor positioning, hedge activity, and technical market mechanics like margin changes and inventory levels. Let's talk about what could unfold next in the silver market, because this is where things get really interesting. Bullish scenario. If industrial demand continues to outpace supply, and if inflation or rate cut expectations persist, silver could resume a broader upward trend. This could see renewed rallies that outpace gold's gains, especially if ETFs and physical silver buying pick up again. The underlying supply shortage and robust demand from solar and EV sectors provide a structural bullish backdrop that could support higher prices in the long term. Another bullish factor would be if investment demand returns in earnest. For example, if ETFs see inflows, or if retail investors view silver as a compelling buy on dips, bearish or neutral scenario. On the flip side, if margin requirements remain high and technical factors dominate, short-term pressure could persist. Higher margins squeeze traders, reducing liquidity and increasing the likelihood of forced selling on any market weakness. If the dollar strengthens significantly, or if macroeconomic data surprises to the upside, signaling higher rates, silver could struggle to rally. Given its sensitivity, silver may experience deeper pullbacks than gold in such an environment. Analysts are cautiously warning that silver's volatility may not be over anytime soon, and that corrections remain possible, especially in the face of uncertain macroeconomic news such as inflation releases or Fed decisions. As we look at silver versus gold in 2026, here's the key takeaway. Gold is the safer, more stable store of value. Silver is the high beta precious metal with explosive upside, but also deep retracements. For investors, this means, depending on your risk tolerance, if you want stability and long-term hedging, gold may remain the preferred asset. If you're comfortable with volatility and looking for outsized moves, silver's structural demand story combined with short-term momentum factors could present compelling opportunities, but only if approached with caution. Breakdowns and rallies in silver should be viewed in context. Trading margins, inventory trends, industrial demand, and macroeconomic news all drive a metal that's far more sensitive than gold. Thanks for watching. If you enjoyed this fresh and comprehensive market analysis, subscribe and turn on notifications so you don't miss daily updates on precious metals and the wider commodities world. Drop a comment if you want tomorrow's live silver price forecast. I'll cover it next.